Our next speaker is Omri Thomas from Abax. Omri has been the lead portfolio manager of the Opportunity Fund since its inception in 2011. Omri, welcome.
Thank you, Nedgroup.
And over to you. We'll have a Q&A after your session.
Perfect. Thanks very much. Good morning and thanks for joining. Quite interesting times. I think as you've heard with a lot of the other speakers, inflation really being an issue. And I think a lot of the Nedgroup solutions are structured around, over time, beating inflation. And similarly, the Opportunity Fund, its mandate is to try and beat inflation +5 over rolling 3-year periods and not to have negative return periods for 2 years. And if we look at that first objective of achieving inflation +5, since inception, we've just got our nose ahead of that target. So we're very pleased with that. So just looking at the last quarter, what's happened, as you've heard from previous speakers, massive inflation surprise. So in dark green on the left, you see the inflation really shooting through the roof. What's interesting is if you look at the lighter green, that's the expectation of inflation in 5 years' time. So the market not really believing that this inflation is here to stay. And I think that still has to play through. The Fed so far has taken it very seriously, front-loaded a lot of the interest rate hikes. And I think the market is starting to discount that they will get inflation under control, and that's why the long end of the yield curve in the US hasn't rallied as much as one would have expected given the inflation fears. But we're in unprecedented times, and so we'll still have to see how it plays out. On the right-hand side, you can already see the impact on consumer confidence and consumer sentiment. It's plummeted. It is because of inflation, because of fuel price, things that the consumer really feels. So the consumer is really feeling the pressure, and it's reflected in consumer sentiment. That's not a great environment for consumers to spend and for economies to grow. In the dark green, I've charted the gross margins of the US companies, and you can see the good correlation. So it will be interesting to see how that reacts. So how has the fund performed in this environment? We're very pleased to say that over the last quarter, despite the massive sell-off in global asset classes, Opportunity Fund has managed to protect capital very well. In fact, we were up 2% over the last quarter, and we're still up year to date. And over the last year, we're very pleased with the return of 17%, given the market only delivering a return of 5%. Our 3-year numbers, and that includes COVID, so that must be seen in context, 11% per annum, and even the 5-year numbers at 8% per annum, slightly beneath what you would have been able to achieve in the market, but at much lower risk. So I think it's important, what does the risk-adjusted returns look like? So on the horizontal axis, that is your return per unit of risk. And so you want to be as far to the right as you can, and as high as you can on the vertical axis. That's your annual return. So since inception, the fund has achieved over 10% per annum at a very good risk-adjusted rate of return. What has helped the fund over the last quarter? So a long-held position of ours, we've always said that we think there's a lot of value in Naspers. The Naspers corporate restructuring unlocked significant value over the last quarter. And it was great to see how our hedge structure over Naspers protected us on the downside. But as Naspers rallied, we were still able to participate in a big part of that upward rally. It has gone through our top end levels, so our position size has reduced, again de-risking the fund to some extent. Our offshore dollar cash position has also contributed handsomely as the rand sold off. And one of our smaller positions, it was small to start off with, Tungela Resources, but the share price was up over 500% over the last year. So that's done fantastically well for the fund. And even at current levels, you're seeing it trading at the under 3 price earnings ratio with a projected dividend yield of over 40%. So it's done well. We have reduced our position just from a a risk perspective and a portfolio restructuring, but still offering quite a bit of value. British American Tobacco, long held favorite of the fund, also contributed nicely over the quarter. And then the recent addition, Auto Home, which is a Chinese tech company, and Chinese tech companies have been hammered. So at the lows, we started seeing a lot of value. They've got cash on the balance sheet, and I mean the market cap is not far above just the cash that they hold on the balance sheet. So we started building a position, and it's actually contributed quite nicely over the quarter. On the downside, our biggest detractor was MTN, a high beta stock, and as the market got sold off, it also took a hit. We still think there's a value unlock opportunity in MTN, so we retained our position. And the other 4 detractors were all different South African bonds. As our bond yields kept on moving up, that impacted the price. But now your yield that you're currently earning on those bonds currently higher. So we see quite a bit of value in SA bonds at this point in time, as Lara also explained to you. So just the market outlook for the rest of the year. I think inflation is going to be our topic, and we've got record high US inflation. That's led to synchronized global monetary tightening. And I think that's increasing the recession risk. So there's a lot of talk about recession, but also this dramatic reaction by the Federal Reserve, I think, reduces pressure on the tightening cycle down the line. And that's why the bond market's not really buying into this inflation story. They think the Fed will get it under control. I think there are a lot of geopolitical uncertainties that could derail that view. So markets expect markets to remain volatile. Locally, as Lara said, we're expecting at least another 250 basis point hikes in the next 2 meetings. So further rate hikes expected locally. After the sell-off, we're starting to see quite a bit of value in select SA equities. So we have started increasing our position in some of those. And our bond position, which we reduced at sort of 2-3 months ago, slightly, we have started increasing it again as we see attractive real returns. So recently, the forex exchange regulations have been relaxed, and that enhances our ability to swap local assets for quality offshore assets. So we have started doing that move, and you can take a separate currency decision. You can do currency overlays to still get to the same FX exposure that you want. We expect earnings downgrades to come through as inflation start impacting companies' ability to pass on those cost increases. We think it's going to be difficult. And globally, as in South Africa, consumers are under pressure. So we have reduced our exposure to consumer cyclical companies. So just speaking of that, as I said earlier, you can just see the correlation between gross margins and consumer sentiment. And we think we're going to see margins coming down. I think another consideration, this is the change in consumer sentiment graphed against equities versus bonds returns. And that just shows the picture of a flight to safety. And we don't think there's been a sell-off in global markets, but current valuations are not at deep discounts to historical averages. So we still think there's downside risk that will probably be driven from the earnings side. As companies come out, disappoint on earnings, you could see further deratings. Apple yesterday in their announcement mentioned that they're slowing down on new appointments as they're concerned about the economy. So even a company like Apple starting to feel those pressures. And so in the next reporting season, it's going to be interesting to see how companies have managed to combat the impacts of inflation. I think a third consideration is there's a lot of geopolitical instability. We know about the Russian-Ukraine war, and there are a lot of global consumers that's starting to rise against authorities. And you're starting to see a lot of civil unrest. When we had it a year ago, on the right-hand side, a lot of civil unrest locally as well. And I think we're also at risk of seeing a repeat of last year as fuel prices and food prices start to impact consumers' livelihoods. Just in terms of where we say asset classes, we think SA bonds offer very attractive returns, emerging market equities, and then select SA equities. In the fair bucket, SA properties, we think fair. Cash has moved to SA cash with the increase in yields, starting to offer attractive returns. US bonds has moved from expensive to fair. You are at least starting to get a decent yield. It is a safe haven asset. Developed market equities, ex-US, also fair, and the rand, we think, as Lara said, in a fair value range. Developed market bonds still expensive, other than the US. Developed market cash expensive, and we still think a select part of the US equity market is expensive. But there's been a big sell-off in parts of that market, so we are starting to see value in parts of the US market. Just our fund positioning, I've highlighted how we've changed it since December, end of last year. You can see a significant reduction in SA equities. We did that quite early on, which was fortuitous, before the markets sold off. And in addition, you would see that we've increased our offshore equities from about 5% to about 11% into the sell-off. And as I said, at the moment, you've got the opportunity to invest in global cash flush franchises at a lot more attractive valuations. So your universe of selection is just so much wider than the 120 companies in SA that you can invest in. So it does increase the diversification of the fund, but also your future potential returns. You'll see that we've still got a very high weighting to bonds. I think the other interesting point is, if you look at the different asset classes that make up a balanced fund, suddenly you've got decent nominal returns. And you've even seen some real returns increasing. So to achieve an inflation +5 target, we think is becoming achievable if one can get inflation under control. So in conclusion, I think recessionary risks have increased. We expect to see earnings downgrades and negative surprises. So that will drive asset price volatility. Geopolitical tensions have intensified as cost pressures threatens consumers' livelihoods. SA equities offers select value. SA bonds, very attractive nominal and real returns. And we've used this opportunity to rotate into cash flush global franchises at attractive prices. So we think where the opportunity fund is currently positioned, with our dual focus of achieving returns, but also trying to manage downside risk, we've got a good mix of capital protected instruments, offering decent yields. We've got a high weighting towards bonds, as well as exposure to attractively valued local businesses. And I think what gives us a floor to the return is the opportunity fund currently has a portfolio yield of about 6.3%. With that, I'll hand it over to Andile for questions.
Omri, thank you for that. That was very succinct.
Thank you.
I do have a couple of questions for you.
Sure.
So the fund has been performing very well. You're way above the 5% benchmark. So the question is, can investors continue expecting such returns going forward?
Yeah, Nila, it's a great question, and obviously it's very difficult to forecast future returns. But if I look at the buckets that we used to build up the fund, what encourages me is that there are attractive assets within those buckets, and the average yield on most of those buckets have increased. So your opportunity to earn a decent return, I think, has improved over the last 3 to 6 months. We are really starting to see good opportunities. So we're quite excited about the fund's positioning and about the future return potential at this point in time.
Look, we are as well. As long as the fund keeps doing what it's doing, kudos to you and the team.
Thank you.
I do have a question from one of the audience members.
Yes.
And I think this is an investor that we have. So the question says, you have significant exposure to long-dated SA bonds. Does this suggest that you expect local interest rates to continue rising?
To not
rise, sorry.
No, as I said, we are expecting it to rise, but I mean we've got quite a steep yield curve.
Okay.
Unlike the US, which has now got an inverse curve, we've got a steep curve. So we think as interest rates get increased on the short end, that could quell the fears of inflation down the line. So you could see a yield curve that flattens and maybe. Well, even if the long end just stays where it is, you earn a very good return. So we're quite comfortable to continue to have exposure to that part of the market.
Okay. I have another question. This one is for myself.
Yes.
So we've currently been seeing this global market sell-off, right? So my question to you is that, are you seeing any pockets of opportunities in certain areas, and which are these areas?
Yeah, that's a good question. So the area that we started to see value, interestingly, is the tech sector. So there are some tech companies that started off at very, very high valuations, and they've been sold down, but they're still at very high valuations. And then there are some of your trusted global names that have compounded earnings for a number of years that have also, in line with just the negative tech sentiment, they've been sold down. And now suddenly you get access to global cash flush franchises at very attractive valuations. I mean, to give you a few examples, I mean, Google, we all know Google, and they just continue to grow their earnings, now suddenly at a 13 PE. I think that's a very attractive long-term opportunity. They've got lots of blue sky potential, and to continue growing earnings. I think they will be continue to be defensive. They continue to take more ad spend. So that global quality tech sector, we've actually found a few opportunities.
Great. Omri, we do have some time for one more question. And the question for you is on the risks in the portfolio. So we have this runaway global inflation. We have local inflation numbers that we haven't seen for so many years. And we have this looming recession. So what are some of the risks that you are seeing in the portfolio at the moment?
So I think the biggest risk for me in the portfolio is our big bond position. I mean, we've already seen a sell-off in bonds, but there currently is quite a negative sentiment towards emerging markets.
Okay.
And unfortunately, we're in that emerging market bucket. And if we started to see a runaway inflation in other emerging markets, impacting their currencies and impacting their bonds. We've seen a small version of that locally, and we don't expect our local inflation to run away. I think we've got a much healthier financial system in South Africa, but that is, I think, the main risk. What counters that risk is when you've got long bonds at 11.5% yield, and say the average bond part of our portfolio has got a duration of 7. Even if bonds sell off by another 1.5% in terms of yield, we'll still break even on a capital level. But then your starting yield for the next year is 13%. So I think that the high nominal yields and high real yields cushion one against too much downside risk in that part of the portfolio. For the rest of the portfolio, as you know, we do actively make use of hedges. We've still got those hedges in the fund. We've make use of capital protected structured notes. That is still about 8 or 9% of our equity exposure is through instruments like that. And I think the last thing that I want to mention is what I also said in the presentation. When you've got a portfolio yield of 6.3%, that provides a floor to your returns. So we are quite comfortable with the fund position at the moment.
And with that, I just want to say thank you so much for coming today. We
Thank you,
really
Andre.
appreciate it. Till next time.
Thanks very much.
Thanks, Omri.
All the best. Thanks.